Welcome, everyone. We're so happy to have you here. Today is Matt and Charlotte. I am the co-founder and CEO here at Capwave, and Matt is one of my close friends that is going to give you a lot of great information around how to stay investor ready while you might not be raising or you are raising, and how to make sure that you always know your numbers. One of the biggest reasons why investors get a turnoff, or what is kind of like a red flag, is actually when you don't know your numbers and when they ask that you are scrambling to get your numbers up top. So the most important thing is actually, how do we build a system around always knowing your numbers? And this is helpful for not only when you're raising, but also how much are you burning and when should you be raising. For anybody that doesn't know about Capwave, we are a system where we help founders raise capital in a better way, easier, with the help of agents, and making sure that you are always investor ready. So that's why we are doing this webinar today. This is what you can expect today. Of course, who we are, why this is important, your metrics that you definitely need to know out of the top of your head. Connecting accounting and forecasting, so how to build that system to make sure that you always are in the know of what is happening. What Capwave actually does for founders, we'll do that at the end, because we first want you to learn as much as possible, and then we'll do some key takeaways and do some bigger Q&A. All right, on to the next one. So who we are. You first, Matt.
Sure. So I'm Matt DeWald. I'm a fractional CFO and a partner at Lavoie CPA. We provide outsourced accounting services, fractional CFO services, and our target is really companies that are in the Series A and up, although we do have clients that are even a little bit smaller than that. But one of our pride and joys is that we really provide the accounting and financial infrastructure for our clients, which includes the forecasting models, the accounting infrastructure, and helping to make sure that those forecasts and accounting numbers communicate with each other, which is a big part of the presentation that we have here today. And hopefully you'll find this to be very informative.
Yes. So I'm Charlotte. I am the CEO of Capwave, and we help founders make sure that they're always investor ready, and that we do most of the busy work where the humans only show up when the meeting is happening with the investor. We don't build financial software at all. What we have built is all the agents that will take you through the whole fundraise. So from your pitch deck to investor matching to talking to investors and getting feedback on how you're doing in your pitches, to doing automated investor updates and whatnot. So it's everything to run your race in a 12-week period, as well as doing all your investor relations in between rounds. We love partnering with Lavoie, specifically for the fact that it's important that you always stay investor ready on your financials. And therefore, we like doing these webinars with you guys. So while we're continuing on this, please feel free to use the Q&A functionality on the bottom right-hand side. You can find the Q&A next to the chat functionality, and ask us questions. In the meantime, we will definitely check those out and answer those. And if you want to come up stage, you can actually raise your hand and we'll let you into the call.
One other thing I might add to Charlotte is that this is actually our second webinar we've done together. And our prior webinar also talked about forecasting from a different perspective, and how to think about developing the drivers that go into your forecast models. That, I know you can find that on our YouTube channel, or the Lavoie CPA YouTube channel, and I think you've got that also posted on your YouTube channel as well, right?
Exactly. Yeah.
Okay.
All right.
There we go.
So investor readiness comes in a lot of forms. And one of the things, I had a conversation actually with one of my VC friends this weekend, where she said the hardest part is when a founder is actually not in the know about their numbers. So often what happens is that a lot of founders kind of know, oh, this is my MRR, or this is my my margins, or this is what, like, they know some numbers, but they actually don't know all numbers. And what happens the further you get into your startup journey, at pre-seed, we might not ask you about specific metrics yet. At seed, and you will see this later on as well, at seed, we start looking into the metrics of what is actually your customer lifetime value, what is the customer acquisition cost that you have, and then you want to really make sure that all trends upward into the right direction. So why do you need to know everything about your financials? It's because investors will ask, and in the end, a deal goes from, hey, this is a great idea and this is a great company to back, to, okay, this now becomes a financial decision. Is this company actually running in a profitable way down the line? It doesn't mean you have to be profitable today, but you do have to have a viewpoint on, like, hey, how do we get there in a perspective? So that's why it's super important.
Okay. So from there, what are the attributes of a well-crafted financial model? And we've got some of these listed out here. And again, we're preparing this from a perspective of kind of really 2 points of view. One is I'm actually an investor. So when I'm receiving financials as an investor from portfolio companies that I've invested in, these are the types of things I'm looking for. But also I help companies to implement and put together financial forecast models. So I make sure that I'm answering my own questions that I'd be thinking about as an investor, and making sure that the forecast models really are kind of representative of the business and the message that founders are trying to convey to investors or prospective investors. And the first thing to think about is credibility. It's not uncommon to see forecast models that have these huge hockey sticks of forecasted growth, and the moonshots that the company is looking for. Now, while investors do like to have a very aggressive model and a founder who's really kind of thinking through very carefully what their marketplace is and how they're going to go find their customers, it is important though that the founders are putting into that a level of trust. Right? What are the metrics? What are the items that are really going to drive the business? So if your population of customers is A, what's the portion of those customers you're going to be getting? And then how are you going to convert them into paid customers? So really want to have a level of credibility in terms of your understanding of the marketplace, but then making sure that that's connecting very nicely into your business drivers. And making sure that your forecast model is connecting the pieces on those two. And again, going back to what I was saying earlier about having a prior webinar, our first webinar really kind of talks about the business drivers and making sure that those are connected. The next thing is making sure you've got realistic assumptions. It's very easy to say that we're going to be doing X, Y, and Z, but if your forecast model is talking about A, B, and C, you now have a disconnect. So you really want to make sure that the vision you have for your organization and your company is aligning with your forecast models, so that way your investor deck is very much telling the same story as what your numbers are going to be presenting. When you're going to investors, it's not uncommon that they're going to be asking for financial due diligence and spending some time understanding your forecast models. You really want to make sure that your whole story is complete and tied together very nicely. And then finally, it's really, there's a level of integrating your core KPIs into your forecast model. So we're going to do a little bit of a demo and explanation of this a little bit further. But if you've got some really core KPIs that are going to be important to your business, make sure that those are coming into your financials on an actual basis, on a monthly basis. So that way you could say, all right, here's where we've been, here's where we're going into the future, and making sure that the past has a clear connection into the future. This is really where we're going to spend a lot of time in the rest of this webinar, is really on this last element. So we have some examples here, and this varies depending on the company. So we have MAU, monthly active users, your churn rates if you're in the software business, long-term lifetime value of your customers, if you have activation percentages or other KPIs. All of that should make sure that your forecast model is marrying up nicely into what your investor deck is doing, and then also, again, tying the past into the future. So when we're thinking about investors and your life cycle and journey, the objective of what you're doing slightly changes as time goes on, right? So in the pre-seed stage, you really want to be setting your habits correctly. You want to really be thinking about what are the attributes and behaviors that you could do today that's going to make your life a whole lot easier going into the future. And what I find is that a lot of companies don't do that. Instead, they build this crazy model. They don't really tie it into their financials at all. And then they lose kind of track, and you have a financial model that's in one place and you have actuals that are in another, and you're not connecting the dots. The sooner you get that behavior and that pattern going on, the much easier it is to have communications and discussions with investors, because now that what they're seeing is a level of discipline, credibility, and updating to your financial model, so that they can then continue to see how you're proceeding with time. When you're in the seed stage, it's important to now start showing traction and progress against your growth story. So think of your pre-seed as being, here's the idea that we have, here's how we're going to go attack the marketplace. Well, you're in your seed stage is when you start really starting to show some traction. So it's really important to make sure that you're saying, okay, we were expecting, let's say, churn rate of A, and what are we actually seeing in reality at the seed stage? And making sure, again, that the past is aligning with future, and then making sure that your forecast models are updated accordingly to continue the trajectory of what you expect. And then by Series A, this is really where you should now be dialed in, right? You should have your moat. You should really know your customer base and who you're targeting. And your pitch deck and the information that's supporting it now should really have some concrete data and information. And you're no longer just in a vision of what you're going to be doing, but now you're in a hardcore execution stage. At this point in time, everything you've done from pre-seed to seed was kind of showing an idea and showing what you want to do. And now in Series A, you should really be targeting and really be executing. So it's in this Series A stage, especially, that you want to make sure that you've got data that is supporting what you're doing and explaining what your business, how your business is going to be performing and running into the future. Okay. So what are some items that are critical to building that defensible financial model? Again, I've already talked about making sure your slide deck, your pitch deck, is qualitatively explaining what is going to be in your forecast model and making sure that there's connections there. So your revenue projections should really make sure that they are tying into the milestones of when you're expecting to have new product launches, new product developments, and making sure that your financial model is, again, tying into the story you're telling to investors. Along with that, you want to make sure your cost structure is in alignment. So that might be if you're hiring new employees, you want to make sure, if you're saying that you're going to be hiring 3 salespeople in March, your forecast model needs to reflect that. And then what's the impact of then hiring those 3 salespeople? How much revenue are they going to bring in? When are they going to be bringing in revenue? So that way, again, you've got now a level of credibility that connects what your story is to what you're going to be doing. And if you have any one-time costs that comes up frequently, you want to make sure that you're baking those into your forecast model as well. And then finally, I think a good best practice is really to have some good scenario modeling. So what does the business look like in a best case scenario? You know, if you way exceed your targets and your revenue forecasts, what are the things that you're going to need to do to help sustain that growth? What are the metrics that you're going to need to make sure you're tracking? What new salespeople do you need to bring in? If you're a software company, what technology and product team members do you need to be adding? Conversely, what happens in a worst case scenario? So if you're expecting a product to launch in June and start recognizing revenue in July, if that doesn't happen until December, what's the impact on your cash and your forecast projections? So you're really making sure you're thinking about the downside risks as well of your financial model. So it's not uncommon that when I'm building financial models, for instance, that I've got 3 scenarios, and it's that low, medium, and high, where usually the medium is the one I'm going to investors with, but I understand what happens on extreme edges if the company does very well or struggles. Okay. So what are some common red flags? When I'm going through forecast models, I'll tell you, these are the things that kind of can really irritate me really quickly and tell me that maybe there's a credibility issue or certainly a knowledge gap with founders that needs to be plugged really quickly. So first off, the chart of accounts. This is often not talked about and really thought about when you're building forecast models. But really, your accounting chart of accounts, so your balance sheet accounts and income statement accounts in your accounting system should be aligning very nicely and very tightly with what's in your forecast model. If there's a lack of alignment, then it means it becomes very hard to make your information very comparable on a regular basis. And as we'll talk here in the next point, is that you should be updating your forecast model monthly. If you're finding that it's taking 10, 15, 20 hours to update your forecast model based on last month's actuals, you have a big problem. That means that you're going to have a hard time turning around your forecast model update, getting your actual financials prepared and presented to your investors. And you want to make sure that your chart of accounts and your forecasts are lining up so you have a nice and simple method for updating your forecast model. Again, I'll walk you through some examples on that shortly. The next thing is again, I'm thinking of the best practices of the reports I'm getting as an investor. The investees or the founders that make me really happy are the ones who really give good, timely updates of their business. They're presenting the good news along with the bad news and making sure that we understand what's happening in their business, how are they doing, what are the things they need help with, and making sure that there's a good dialogue. So as a founder, it's important for you to be thinking about those communications all the way at the beginning. If you think that you're going to be going down a path of raising capital, start thinking about how you're going to be presenting information to your investors from day one, even before you have them on your cap table. Because when you have that discipline going in, it makes it a whole lot easier coming out. Another item, again, big red flag that I see very regularly is not reconciling to cash. Seems very simple, but a lot of forecast models I see do not reconcile to cash, and they are not explaining the cash flow burn. They're not explaining where they think they're going to be cashing out, and then even thinking about when their next fundraise needs to happen. So reconciling your forecast model to cash is a very critical component. Again, I kind of walk through an example of that coming up. And then finally, this goes back to the first point of your chart of accounts. It's very important to really keep a high level of discipline on your chart of accounts. So making sure that you are not making unnecessary changes to your chart of accounts. Set it once, lock it in stone, and don't make any edits unless there's a really significant or important change to your business. Again, when you have changes to your chart of accounts, it makes it very difficult to make comparability into the future. So make your life easy, get your chart of accounts set straight, and then make sure you've got that then going forward between your forecast model and your accounting systems. Okay, so here's an example. This is actually a live client, an actual client example of a forecast model that I've been working on very recently. And this is exactly what the client sees, and this mirrors the information that's actually coming out of the accounting system. So our accounting systems are capturing the KPIs that we want to be reporting on. So when we're putting in the actuals, it's just a straight copy and paste or lift and load straight from the accounting system right into the forecast model. So what are some of the metrics in this case that are really critical? We've got number of visits. So this is a company that's in the health tech space. So the number of patient visits is really critical to what they're doing. And you'll see that we've got a forecast for what that looks like on an annual basis here in the top line. Gross revenues by visit. Again, critical metric. We want to understand how does that change over time? Why is it changing over time? And then this becomes part of the story that matches up very nicely into their slide deck, into their pitch deck. Net revenues per visits, contractual adjustments. If you're happy to be dealing with insurance companies as a payer, you'll understand what these terms mean. These are very important to this company. And so we make sure that we've got a clear understanding of the connection between gross revenue and net revenue. As you'll see here, there's a number of app subscribers. So they're looking to build an app in the future. As you can see, it's looking to launch in 2026. And they've got then a forecast model that supports the number of subscribers. And you'll see that that also ties in nicely here with the revenue for software. That also, again, ties in very sweetly with what they're doing in their pitch deck to indicate their launch date of that app, how they're going to get there, and then what costs are going to be needed in order to maintain that app. And then finally, you'll see that we've got like a mix here of time periods, right? So this financial model was prepared and completed through September 30th, 2025. And so what we have is actuals of 2024. We have 9 months of actuals of 2025. And then we have 3 months of forecast. And then the remaining periods are a forecast period. They're keeping a very good, tight discipline of making sure that this forecast model is staying up to date. And then again, they're making sure that they're turning this around very quickly to investors, and they're not having to scramble every time when someone says, give us the latest forecast model. They've got it up to date every month. So here's kind of an expanded view of 2025, right? So going back, I was showing it on an annual basis. This is then showing what we're doing and how we're tracking things on a monthly basis. Again, we've got monthly growth trends, which becomes very important for the future forecast. So we could start seeing, okay, here's what we're doing on a month-over-month basis in terms of number of visits. And then you can see what we're forecasting then into the future. This then again helps explain the trajectory and the timeline of growth over a period of time. These number of visits, again, on a monthly basis are coming straight out of the accounting system. So we're baking that KPI right into their accounting system, which makes it very easy to drop in these amounts on a monthly basis in order to get those actuals updated on a regular basis. Okay. And again, I'm going to reemphasize, right? So each month here has the process for updating this is literally a matter of minutes. Updating this forecast model does not take us 3 days. It doesn't take us 3 weeks. It is a matter of hours. And that's the level of cadence and discipline you want to be in. Okay. Next is, this is on the chart of account side. So again, you'll see that this chart of accounts is right out of the accounting system, and their forecast model is marrying up straight up to that chart of accounts. This then allows us to see, for instance, if salaries and wages, there's an increasing cost here. There's a separate level, there's a separate tab that helps support what those costs are increasing by and which departments those are coming from. And by having this straight in their accounting system, but then also marrying up to their forecast model, we've got perfect alignment at all times, so we can very easily understand the forecast versus actual and how we've done that. Okay. We talked about reconciliation to cash. This I'm going to continue to emphasize. Really think about what happens in the course of the business that will impact not only the forecast, but then the reconciliation to cash. So here's some examples that we've got in this example. So as you see, this is a fairly small item, but they're thinking about prepaids. Maybe there's a specific prepaid, such as insurance, business insurance might be a good example, that gets paid once a year. You'll want to think about the cash implication of that, even though it might be straight lined throughout the year on your income statement. You want to think about what's the timing of when that gets paid, because if that's a big payment that needs to go out, you want to make sure that you're planning for it properly. In this space, they've got cash collections that are about 30 days after the service date. So as revenue is increasing month over month, it means that they're not necessarily seeing that cash right away, but they're seeing it on a lag basis. We're accounting for that here in their model. So we're indicating what the cash implication is going to be for that collection difference between when they recognize the revenue versus when they collect it. You'll see here they've got an equity raise line, right? So they were anticipating getting safes, and we dropped that in here based on the date of when we were forecasting to close that event. So that way we can, again, have a good reconciliation to cash. And then, as you'll see here, we were actually forecasting they were going to be going negative in January. So then that becomes part of the dialogue of how can we advance, for instance, this equity raise to perhaps be a month sooner, so that way the company can anticipate cash deficiencies and shortfalls. And then finally, we thought about too, capital expenditures. So that's not necessarily going through their income statement, but we need to be thinking about the cash implications of when they're going to be buying certain expenditures. In this case, this actually related to their app development. And so we wanted to make sure we were bringing in the cash implications of when they're building that app. And you'll see that then this reconciles to their ending cash and is rolling forward on a monthly basis. And as time goes out further, we can then identify when's their cash out date, which then triggers when's the next need to doing a capital raise. Most investors, depending on the stage of your business, are expecting 12 to 18 months of runway. And you want your forecast model to, again, reflect that. This also then becomes very important thinking about how you're managing your cap table. So this is kind of outside the scope of this presentation, but we want to be thinking about in the future, what's the dilution impact of $3 million versus $4 million or 5, and that becomes, again, part of that sensitivity analysis that becomes very important to really understanding your cash projections. So what are some next steps? Again, I'm trying to help avoid the problems that I see when I'm getting forecast models from founders, trying to help make you smarter and better at what you're doing which will then increase your odds of getting the investment dollars you're looking for and to finding the right investors that will help support your goals. So what are the things that you should be doing? One is really thinking very carefully about your revenue goals and being really reasonable about them. You can expect a lot of dialogue and push and pull coming from discussions with investors, but you really want to have a supportable pathway to how you're going to attain revenues, how you're going to meet those goals, and the costs that are going to be required to get that. As we demonstrated, you want to make sure that you're really thinking about your core KPIs. That varies by industry. So you really, so if you're in the software business, you want to make sure you've got at least some kind of factor in there for churn. Even if it's small, or maybe that's something that increases as time goes on and you get more scale. That would be an example. If you've got active users, so we talked about monthly active users, whatever those KPIs are, make sure that you're tracking them. You've got a good metric, good systems for capturing that information. And again, to the extent possible, trying to make sure that you've got that in your accounting system so that becomes part of your cadence and your reporting mechanisms. Monthly reporting cadence. Again, it's very frustrating when I get a forecast model that has clearly not been updated in 6 months. You want to show a level of commitment to knowing what your financials are, knowing what your numbers are, and being able to report and discuss where they are now and where they're going into the future. And the best way of doing that is really having a good monthly reporting cadence. Again, even if you don't have investors on your cap table now, start really thinking about how you're going to be communicating financial updates to your investors. I would suggest you do this before you have investors, so that way you have, again, the practice, the discipline, and you're thinking about the communications that you're doing. Even if you're sending that email correspondence to nobody other than yourself or your best friend, have a level of discipline around that communication and thinking about what you want to be telling investors, because the more you're doing that, the better you'll be, and the more and then that makes your communications with investors that much easier. Always understand your cash position. Where are you now? Where are you going into the future? And what's your cash burn rate? It's not uncommon that I ask that question to founders, and I say, what's your cash burn rate? And I hear all sorts of crazy numbers, and really they haven't really thought about it. So you really want to understand what's your core cash burn rate, especially in the early phases, that then helps you to understand how much time you've got with your current cash position, how far you can get with it, and when you may need to make your next round. Can't overemphasize this next point enough. Clean up your chart of accounts. Make it simple, make it consistent, and make sure your forecast model and your accounting systems are in perfect alignment. Next is understand when your upcoming capital raises are. So we talked earlier about being pre-seed to seed to Series A. All that should be in your 5-year forecast model. You should know when those trigger dates are going to be, how much they'll be for, and what you're going to need to do with those funds when you get them. So if you're going to Series A and you think that really what you need to be doing is investing in sales and product development, make sure you're representing that in your forecast model and showing that the proceeds that you get are going to be investing in those areas. So in your forecast model, we should see very clearly, I'm adding these payroll or this headcount, where they're going to be, how much you're going to be paying them. And so that way you've got, again, a tight story between your pitch deck and your use of funds. And then finally, really make sure that you've got then your financial results summarized and on a regular reporting cadence, should be monthly with your investors. And be transparent. Let them know what's happening in your business. If you miss targets, understand why, how you're planning on catching up. If there's good news, share it with them. If there's bad news, share it with them. And then never forget, investors are in this with you as well. They want to see you succeed. So what are the asks that you have of them? What are the things that the insights and maybe the relationships that you're looking to build? And I would always be honest in asking your investors about how they can help support you and your business. Okay, Charlotte, hand it back over to you.
Yes, amazing, Matt. Hey, everybody in the call, feel free to ask questions, raise your hand in the meantime. I'm just going to give you a little bit of an overview of where Capwave comes in, because your financials are super important. This is all about the discipline, and this is indeed like the second webinar based on how do you build your financial model and how do you basically not let it collect dust, and how do you make sure that you constantly are in the know of your numbers, and to make that as easy as possible. And we would love to give you more information about that and on how Matt usually sets up these systems to make sure this is as easy as possible. And it's more about the prep in the beginning to make sure that you know your KPIs, you know what you're tracking, and then setting it up right in the systems to make it as easy. Okay, so where does Capwave come in here? Capwave is really a system to help you raise capital as easy as possible. We've raised more than $450 million ourselves with this particular system. So what that means is we use AI agents to be able to help you on your capital raise. Here on this slide, you can see that as part of your capital raise and of your investor relations, there are multiple things that you need to do. One is, of course, have an amazing pitch deck. So we've built Pitch IQ to be able to review your pitch deck like a top-tier VC, like Sequoia or A16Z, and give you the feedback that you need and a rating on your pitch deck of like, hey, does this stand out to an investor? So when you start out going to send your pitch deck to certain people, okay, is this actually, will this hold up? And will I get a meeting out of this? Then we have Investor IQ. We track over 90,000 investors on a daily basis based on what they have invested in. So not only what they say in their thesis, we actually look at their portfolio and do analysis on their portfolio, as well as on all their appearances in podcasts, what they talk about on ads, what they talk about on LinkedIn. And then we create a sentiment of what this investor currently likes for their current funds. What we then do is we take the information we got from Pitch IQ from you guys, and then we match you to a subset of the 90,000 investors that we have on our platform. Then what happens is that based on that, we say, okay, based on your network, this goes into Intro IQ, where can we get you a warm intro? So now we have your deck stands out. You're definitely going to get the meeting. Who do you need to talk to? Investor IQ. intro IQ, how do we get you in front of this investor? So where can we find a warm intro? This can be through potentially the founders that are already part of their portfolio, or maybe you have an advisor / investor like Matt, and he knows a certain investor that is a great match for you. So you get your fit score. We make sure that you get in front of the right investors. And then we're currently building Meeting IQ, which basically gives you briefings on why you are the right match for this particular investor and how to go about this meeting. So when you get into the meeting, you know exactly, okay, this is what this investor is doing. This is why we are the right fit, and hit on the right signals when you're in the meeting. And then we are also creating an integration with your notes. So if you do a virtual meeting or you actually record a meeting in person, that could happen as well, where we can then give you pointers and feedback on your transcript of your call. So if you said a red flag, for example, I talked to a founder last week and he said to me, we're raising between $1 and $2 million. I said, so what is it? Is it 1 million or is it 2 million? Because I need you to know exactly why you're raising a certain amount. What you could say is we're raising between 1 and 2. That is okay if you want to say that. But then you say, with 1, we can at least get XYZ done. With 2, we would be able to also get ABC done. So be super clear on how much you're raising and where that will get you to the next milestones.
Yeah. That
so
actually ties in nicely with the multiple scenarios I was talking about earlier.
Right.
So you may have a scenario that has a medium scenario, let's say is 1 million, but a high scenario that's 2 million. And then you show the incremental growth that you're going to accelerate as a result of 2 million. Yep.
Exactly. So we now make sure that your materials are good, you're talking to the right investors, you're getting warm intros, and now we also make sure that while you're doing these pitches, we don't want you to do more pitches. We want you to be as good as possible in every pitch. So we tell you the red flags that you might have, pitched in your previous meeting. So in your next meeting, you won't do that. And then Update IQ, that is primarily for doing those updates on a regular basis to your current investors, prospective investors, and I call them the Capwave friendlies. So this is where I explain how the business is being built, what we've learned in the last month or in the last quarter, and how we're going about it in the next one. And then you see the Raise OS here on top. This basically is the chat interface where you guys can chat and ask questions. We have a full academy behind Capwave as well. So if you get an investor question, you can ask it in the chat, and then basically we'll bubble up what you should answer and how you should answer and how you should go about this. To give you an idea of like what is really great if you're raising today is if you actually start uploading your pitch deck, of course, so we can give you feedback on making sure that you're standing out. But also number 2 is using your profile. I'm going to quickly share my screen here. Matt, I'm going to take over for a second. So this is a company called Raindrop. They were a Y Combinator company, and they recently raised $50 million. They basically use the Capwave profile to be able to know exactly which investors are actually looking at their profile and how to update them on a regular basis. So, for example, they use the updates to be able to show, hey, this is how we are building the business. You can see it right here. All their investor updates are here. So instead of only sending emails to your investors, you now also have a dashboard where an investor that might be new to you can read through all your updates and how you've been building your business on a regular basis. And therefore you can build trust through your historical updates that you've done. So you can see here exactly what they've done, highlights and wins, what's not working, what we're building and prioritizing next, and how you can help. You can look at previous updates, next updates, and this is how an investor can really feel that trust earlier on. Here on the left-hand side, you can see some traction highlights, and you can share this with different investors. So you can create a link. For example, you say this is for the friendlies, and maybe I do want to tell that or do want to show them the pitch demo, the committed amount and updates, but maybe not the traction highlights, your data room, and your pitch deck. So you can decide on how you exactly want to use this. On top of that, there's a data room. You can add more information there for really the investors that are super interested and are potentially doing due diligence on you. And then you get profile analytics where you can basically see everything that an investor is doing on your profile. So this is a really great way to kind of like capture that interest. This is specifically built for the way investors usually evaluated deal. So now you look really great from the get-go, and you can make sure that you know what an investor has already seen. It's similar to DocSend, but a little bit more elaborative. So with that, I would love to open it to questions that you guys might have. You can raise your hand on the bottom and we will let you in. Or you can use the Q&A functionality to ask a question. Okay, I don't see any questions yet.
Because you did a great job presenting.
I think so too. This is great. Well, maybe then we are going to give you some time back. Matt, is there anything else that we should discuss?
Yeah, actually, we talked a bit about investor updates and making sure that your metrics are up to date and knowing them cold. Do you have any best practices that you see? Again, you're kind of seeing the whole marketplace from both sides. What are some best practices you see in terms of keeping KPIs up to date, knowing them cold, keeping financial forecast models relevant?
Yeah, I would say that for every founder, it's really like you have to revisit your KPIs and really prepare what KPIs you're going to track early on. And that might also change as you keep going. So for example, for Capwave, right? We want to be able to help 10,000 founders raise their round in 2026. We are well on track, but basically how we track that is by having 10,000 users and very active users, and making sure that we see also if the active usage is going down, that maybe we need to reach back out, or maybe there's something wrong in our product. We use different tools, for example, to be able to also see what is happening with our users. So now I, as the CEO of the company, can say to investors, hey, this is what our learning was. We see that our active usage is going down, but it's not bad because of XYZ, or it is bad because of XYZ, and this is what we're doing about it. I think the main reason why I've been very successful in raising capital specifically is because I keep investors in the loop and I explain how we're doing things. But it's super helpful if you also have the right systems in place to be able to see that, right? And I think that that's where a lot of founders don't spend a lot of time, which I totally understand, but it actually helps you if you spend a little bit more time there in the beginning to be able to really continue being on top of everything. Because in the end, investors are financial animals. So that means that we like metrics, we like that you know about what you're actually doing. And we don't like a lot of fluff.
Yeah. One of our taglines is you start the way you want to finish. And that's really critical, right? If you're thinking about your business and you want to be investor friendly, you need to start that way. So that way you can end that way. Now, do you have preferred mechanisms or communication tools for updating investors? So is it just emails, written summaries? Does Capwave have that functionality? Maybe talk about what's the best practices for actually executing the live updates.
Yeah, so we use Capwave, of course. I think the main insight for doing our updates in Capwave and for building this actually for our founders, our users as well, is primarily for the reason that a lot of investors get a lot of updates, but it all gets lost in their inbox. So what happens is that, yeah, okay, I stayed top of mind by sending my updates, but actually we are not able to, or an investor is not able to find it in their inbox anymore. Now I can say, hey, I send it to you per email, which also goes through Capwave. So basically how it works is I update it on Capwave, I send my update, and I do it in a very organized manner. So you can also see between the different updates what happened actually. And then when I click enter on Capwave, it sends it to everybody's email, and it also collects it in my profile. So now an investor can see it in their email the way they have been getting these, but they can also go back and be, oh, what has Capwave been up to?
Gotcha. That's great.
That's how we do it.
Nice.
I saw that we got a question. Huh?
Yes. Yep. I saw it too, and I don't know how to see it. So hopefully you do.
Okay. How does Capwave differentiate its platform features for founders at different stages, pre-seed through Series A? So the pitch deck analyzer is specific per stage. So what that means is like when you are a pre-seed company, we'll give you way different feedback on your pitch deck and rate it in a different way than if you are a Series A company. Of course, the same holds for the investors that we track. The 90,000 investors is from pre-seed all the way to a Series C. Because eventually we'll be building more and more functionality also for the later stage founders. But today our ICP is really between the pre-seed and raising a Series A. And how we differentiate it is by making sure that you get the right feedback on your pitch deck specific for your stage, you get the right investor specific for your stage, and so on. The profile itself is not that different for a pre-seed company compared to a Series A company. The only thing is that you will see different metrics and that you will start to be able to show different metrics in your profile. Amanda, I hope that answered your question. If you have any other questions, feel free to raise your hand. So one other thing, for example, about the update specifically, Matt, is that what we track as Capwave is really like how many subscribers we have. So what an investor can do when they actually get my profile. So usually, if you're new to me, Matt, I will say like, oh, well, feel free to track us here with my profile, and then you can add yourself to our watch list. So basically, you can say, oh, I want to track Capwave going forward. That means that I see the subscribers going up. I will quickly show you how that works. But basically, here, when you go to updates, I can see how many people have actually added me to, or added Raindrop in this case, to their watch list. And therefore, whenever I create a new update, I basically start writing here, and then I can manage who will actually receive it. And then I just click next and I know exactly who it's going to. And then we track who opens that and whatnot.
That's huge. So this is investors now coming to founders very
Exactly.
proactively, and now have a mechanism for tracking their success, as opposed to just saying, send me your pitch deck and it gets lost in a pile.
Right.
They can actually see those updates and those metrics climbing and growing. That's great.
Yeah. So we're closing the loop also, because the whole point is like once you send your deck, then you actually don't know if an investor looks at it, if they did or not. Even if you use DocSend, you will only see what slides they have been on, but you actually don't see have they read my updates, have they not read my
Did we lose you, Charlotte, or is that on my end?
A really cool thing, Matt, is that this year we partnered with Venture Atlanta, where all the people that were selected to pitch on stage had their QR code of their Capwave profile on their slides, and they could real time see how their pitch landed by seeing how many people actually viewed their profile. And therefore, we were able to predict who was actually winning the pitch competition.
Charlotte, you're a marketing genius. I need to learn a lot.
Thank you. Yeah. No, so it's really cool. And it's like we're trying to, I guess, like give founders more insight in like, hey, how's your race actually going? And are you doing great? Where can we help you become a better capital raiser?
That's a good point you brought up, actually. Is that something that you think is a best practice to be communicating? So if a founder is looking to raise $1 million, and let's say they've got $500,000 committed and they're still looking to raise another $500,000, do you think that that's an important metric to be communicating as part of your monthly metrics? Does that help investors to connect with founders, do you think?
You mean like communicating how much there's left?
Yes. Yeah.
Yes, so as part of the update functionality on Capwave, we actually have a section specifically ask for help, and this is very, very important because the founder should always ask for some sort of help, and that can be while you're raising, like, hey, we have $500,000 left, or we have $1 million left. This is our leads. We have conversations with these people. I still would like to get some extra intros to these people because, as everybody knows, multi-threading, that means like multiple people talking about you will get you more in the picture. Especially if you're not based in San Francisco or New York City, like it's super helpful if you can basically get your minions to work for you and help do some whispers.
Yep.
So you should always ask for help, and that can be related to your capital raise. That can be related to your users. Maybe you just want some feedback on a certain feature, and you never know, out of the 270, 300 people that you have on your investor updates that are actually following your progress, you never know who can help you. I did a webinar actually last week around how to make best use out of your cap table. And one of the reasons is, or one of the ways to do that is by making sure you're always asking for help and you're very clear in articulating where you need help.
You know, you raised a really good point that I want to underscore, because, you know, I'm an active angel investor in the Charlotte community, the North Carolina ecosystem, which is kind of, you know, a tight-knit community for sure. But what I see in the angel funds that I'm part of is they will be looking to see what other angel investors are doing in other parts of the Carolinas. And there's a level of credibility that goes along with it. So if I'm in, you know, angel fund A, and they see that angel fund B has made this investment in a company, there's a level of credibility that goes up immediately, because they all kind of know each other and the standards that they're looking for, the due diligence process they go through, and it scores points basically for the founders when other people are investing. So there's kind of a buzz and an excitement that starts happening.
Yeah, totally. Yeah, and this is why it's important that you know, keep everybody friendly and be nice to people, because people do talk, and investors especially talk. I'd say one cool insight, since I come from the investment side originally myself, I'm now a founder and I'm on the other side, and it's been very interesting. But I think one of the insights that is very helpful for everybody here is that once you start going out to raise, you don't want to do that unprepared. Not from a financial perspective, but also not like meaning you need to know your numbers, because that was what this webinar is about, but also on how you're telling your story, because you get one chance to make that first impression. This is why we have Pitch IQ, to make sure that you are using that one chance like you are that 1% that actually gets funded, because it's very hard to raise capital. So I would say that it's super important that when you do this, that you actually make sure that you are ready to raise capital, because once you start doing it, everybody talks to each other.
Yes, 100%. Yeah, and I see that quite a bit, actually. That's a really good point, is there's definitely a lot of communicating that's going on. And I'll even say that, right? So as an angel investor in fund A, I may see that we're making an investment, and I'll say to fund B, hey, wait a minute, I'm really excited by this one. You may want to look at that. And you start gaining some momentum that way.
Yeah, exactly. Or not. So if you if you go too early and you are just not prepared with your pitch, and you're just not sending the right signals immediately, it's just going to fall flat, and people are not going to take you serious, and you're kind of destroying your reputation at that point. So it's super important that you do some investor readiness. And by the way, people can do that for free on Capwave. So go on Capwave, make sure that you're ready, because it is super important, because we all talk.
And, you know, this is not common, but I will say one of the investment funds that I participate in is very friendly. So it's not uncommon that they've got an investor who pitches and they struggle with that first pitch, and a year later they come back and pitch again. And I've seen that even up to 3 times. Most angel funds, and certainly early stage investors, are not that friendly. So you're right. You really want to go in there with that first impression being the strongest one, and expecting that the people who you're talking to are going to be talking to other people as well, good and bad. Yeah. And you really need to be thinking not only about this current presentation, but really the impact that it has throughout the community that you may not be aware of.
Yeah, and I would say that it's very normal that most founders don't know how to raise capital initially. That is very normal, because this is a very unique skill, and you need to learn this skill. Today on Capwave, we actually have a full academy where we can teach you, or where we do teach you exactly on what you need to know of the investor language, as I would say. But even myself, right, when we hold a lot of events, and when a founder comes to me and they're not nailing it within the first 30 to 60 seconds, I'm already checked out. And I'm
Yeah.
like, okay, you're probably not building a great business, which is so bad. But unfortunately, this is just the way it is. And investors have huge egos. And we want you to hit on the right points the moment you talk to us. And then it's like, oh, let me hear more. Let me hear more. And I extend the time that I'm giving to somebody to explain more. And this is not me trying to be very shitty right now and telling. I think that founders need to understand I need to show up as my best self from the investor perspective. Investors are not on the pedestal, and I'm just going to treat them as equals. But in order to do so, you need to come very strong.
Yes. Yeah. One of the things, a red flag that I see is when a founder describes their business or the solution they have as being very complicated. I've probably seen this 5 or 6 times where someone thinks that what they've got and what they've created is so complicated that they can't explain it. Well, if they can't explain it, then it becomes very hard to invest in it.
100%.
So that is one word I would say that if you're a founder, watch out for that word. Just avoid it. You really need to, going back to your point, you really need to solidify. You've got to have that elevator pitch, that two sentences that explain your business and what you're solving for, really nailed down. So that way everyone can understand it. And they will then want the follow-up questions to ask for more.
Yeah, 100%. Hey, Matt, this is great. Everybody here on the call still, if you have any questions, feel free to email us. We will send a follow-up email for sure. And yeah, thank you for joining.
I'm going to get back to sharing my screen real quickly because we do have contact us. Here's how to find us. Okay, look at that. So Shari Lavoie is not on this call, but you can always reach out to her as well. She's the founder and CEO of Lavoie CPA.
Amazing. Well, thanks, Matt. This is really, really great. And we'll share this contact information as well with everybody after this call.
Excellent. As always, great talking with you, and thank you for the time and appreciate being here.
Same. Have a great rest of your day.
Thank you.
Bye-bye.
Bye.